Hello traders, Gary Wagner here. Just before 10:30 in Honolulu, 4:30 in New York. It is Wednesday, July 27th, 2016, and this is the Daily Report for Gold and Silver. Following statements at the conclusion of this week's FOMC meeting, in which the Fed stated interest rates will remain unchanged from where they are, which is in essence a quarter to a 0.5%. We did have gold and the precious metals complex as a whole begin to move to the upside. Gold currently trading at $1340.80, putting it up about $20 on the day. That's just off the high of $1342 and change. Low on the day, $1315. We did send out a trade alert just when the market broke above $1330. As we spoke about on yesterday's show, that was the technical evidence we were waiting for confirmation that a bottom was in fact in play. Stops below $1305, but of course we're going to cover our current trade in detail all on today's daily report. So traders, here we are. Markets have effectively closed for the day. Gold closing up about $20 on the day, $1341. If you recall from yesterday's show, first of all, I talked about with a little bit of fascination, a lot of amazement, just how well different fib numbers tend to track ahead of time various levels of support and resistance that we at least need to be looking out for. We talked about the fact that as this market came down, it hit a couple of areas. You notice the first green candle, I'm talking about this one right here, came in, and this is that 38% retracement point. Now, absolutely, it did not hold. It went to lower lows on the following day, but it was an attempt, I believe, absolutely, to see if there was any kind of support in that area, which in hindsight there was not. That told us that we wanted to look at the next couple of levels. One of those levels was the 50%. The level behind it was the 61% retracement point at 1301. We had our first real clue or indication when we had this engulfing bullish come in, and this was just a few days ago last week. However, if you notice, we had that red candle come in on the following day, which in fact negated that pattern from actually triggering a buy signal. The reason being that we didn't get the confirming candle that as a rule, I have developed. The confirming candle rule is something that myself and my partner Brad Matheny, which is the gentleman that was the programmer behind the Candlestick Forecaster, which was a software program that I developed in the early 90s to automate or identify candlestick patterns. We realized as we went through and did a lot of statistical analysis that without a confirming candle, these short-term patterns, these 2 and 3 day patterns, really didn't give you the kind of reliability needed to place any kind of a bet with. Now, market comes down, and we talked about the fact yesterday that we had this green candle here, but more importantly, we were starting to see either consolidation but a base forming at these particular areas. Now, I know I'm paraphrasing myself from yesterday, but I said in essence what we really need to see to verify that what we're looking at is that V, that pivot or key reversal area, is that we needed to break above 1330. Now, 1330A is a fib-based number, and B, if you look, you can see the headwinds that came in as this market was range-bound, and we talked about that also yesterday. So when the Fed met yesterday, concluded today, and came out and made their announcement, interestingly enough, was just following the announcement, gold actually went down a little bit. It was tracking about $5, $6 higher, $7 higher, went to about $3 higher. And I said to myself, I really believe because of the fundamental news that we will get a break to the upside. But again, I wanted to follow my rules, and my rules simply said we needed the confirming candle. If you look at this 2-day pattern, although it's not a very, very strong one, you do get a piercing line. And today being the third day, that would be here, here, and here. This is your confirming candle. But you got a piercing line. It was a green candle that closed at or above the midpoint of the prior candle. Midpoint I look at is the bodies. We certainly saw the move up, but it wasn't really until it broke above 32 that my last piece of criteria was met, which was that's the breakout that I was looking for. I considered getting in the market or issuing the buy signal a little bit early. What really held me back, of course, was the fact that we wanted to see, because we weren't waiting for the market on a closing basis, because that is the preferred thing, is to actually enter the market now at 1341. I felt that we were taking not that much of a risk by actually entering it at 1332. Traders taking the call, obviously, we're in at around 1332. Now, I've got stops below 1305, and the rationale or reason for that is you've got these lows coming in right here at about 1309. And so my sense is that as long as it remains above this price point, of course, we should have a safety factor. However, as you know, if this market continues to move in our direction, what I will obviously do is trail stops up, as we always do. So we're above 32, and we want to discuss finally an exit strategy. The next target we want to look at for any kind of resistance is 46, 1346, and then we're just going to really move up along that Fibonacci scale. And to do that, we want to look at these numbers here. So the various numbers we want to look at in terms of targets, of course, we've broken through 1330, closed at 41. Next is 46. Above that is 71, and then above that is 1399. Those are the three targets I believe we at least should see this particular leg of the rally move past 71. And my exit strategy in terms of an ultimate goal would see the market kind of come up and test roughly $1,400 in at 32, out around 1,400. That would be a excellent trade. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for another daily update and review. Bye-bye.